Good day. Welcome to Savannah Investment Group. My name is Runyararo, and today we are going to talk about something that is pertinent upon your investment journey, something that will enlighten you and be able to guide you as you navigate the murky waters of investing. The topic for today is going to be on strategy. How do you go to the investment markets with a strategy? That is the theme that we are going to talk about, as we see many are lacking it from interaction through social media. So without wasting much time, let's dig into it. How do we define a strategy? Put simply, a strategy is a map of your journey. In other words, you want to come from a point of poverty or lack to a point of plenty. For many, the goal is financial freedom. So you want to have a strategy to say, this is how I am going to attain financial freedom. So that's that on the definition part. Now you need to consider factors that affect your investment strategy. For example, you are someone who was born in a poor family. You do not have any inheritance from a grandparent. Your own parents are struggling and they look up to you for sustenance and upkeep of your siblings. How then do you design a strategy to work with that kind of scenario that you have, such that along the way you don't hit speed bumps or you don't completely crash out of the goal that you have set for financial freedom? So these factors build into what is going to define your strategy. So for example, a person who is starting from zero cannot expect to grow at the same pace as someone who has started from 1 million, for an example. The distance that you have to cover to catch up is quite immense. So you need to put in more and get more out of the markets than the one who started prior to when you started. So this is the backdrop of where your strategy needs to be. Most times I'm seeing people who are adopting strategies from maybe fund managers or people who are working in the big corporations. They are told you need to put money every month consistently, buy a certain basket of ETFs or shares via debit order. Then after 10 years, you should be able to see things working out for you. Unfortunately, that doesn't always work. As we have alluded to in earlier videos, the investment world or the financial markets are very much like the ocean. In the ocean, you have times when you've got low tide, you have times when you've got high tides. You get hurricanes, you get strong winds, you get tidal waves, you even get tsunamis. So if you want to get into the ocean, you have to be strategic. You're not simply going to say, I'm going to the beach, once I get to the sand, I'm going to jump into the water. If you do that, you might ruin your life or suffer tremendous loss. So why should you then get into the ocean of money without any regard to the conditions that are prevailing? That will not work for your good, because you are expecting to do random things and come out on the other end with a definite solution or with a definite result. That usually does not work. It's like you're trying to play lotto in the markets, hoping that one day you hit the jackpot. Unfortunately, you might die without hitting that big number. So you need to have a solid plan. You need to say, if the tide is high, I'm not entering. If the waters are murky and violent, I'm not entering. I'll sit on the side and wait. That is the philosophy that you need to build into your investment journey as you go along. So like I have alluded to regarding your background, you need to ensure that your investment strategy is able to absorb all the shocks that are likely to come your way. because of where you're starting from. If a sibling gets sick, it should be able to cover that without you capitulating. If maybe there's a death in a distant cousin, you should be able to cover some of the expenses without feeling like, oh, this is black tax, I'm losing my money. You should be able to enjoy your investment journey and actually be grateful to be able to give some of it. I always say what we give is the gratitude that we show to God for allowing us to be able to participate in the financial markets. Now, you might not believe in God. You can choose whatever you believe in. If you believe in karma, or if you believe in good fortune and good luck, then you can look at it and say, okay, I have been lucky. I managed to get so much out of the markets. Let me extend this one with gratitude to somebody else in your family, or maybe even a stranger who's in the doorgrams. So that's that on the factors that you need to consider. After you have the factors, then you now need to pick your entry points. Like we said, you don't just jump in. You don't put a debit order and automatic buys every month for a position. You need to be strategic. If I had 500 Rand extra every month, would I seek to buy every month in the market? No, because the more times I buy, the higher or the more the frequency that I'm going to incur commissions and other costs. I would choose to set that money aside for maybe 6 to 8 months. Then you invest it as a lump sum. Therefore, you save on commission, and you're also picking a spot that you want to enter so that you are at the most advantageous position when it comes to entering the market. You need to ensure that you pick the price that works best for you. And that price is usually for you to buy at a low price, and the momentum carries you as price goes to the upside. Rather than saying I'm going to buy anyhow. The downside for that is that when your debit order hits, it's likely to come along with maybe another 1,000 debit orders, because people are investing mostly in a head kind of situation where they are doing the same thing, buying the same ETFs and all that at the same time. So you are going to bid up the prices. This will create a temporary excess demand in the market and pull the price higher. When that tide goes, then prices begins to revert downwards. So it's like you always buy into strength, and then price reverts to where it's supposed to be. Then you are losing out because you buy at the top, then price reverts downwards. So please make sure that you do some analysis before you dive in and buy. Then the most important thing is the exit strategy or the exit point. Many people are going into the ocean. They catch a lot of fish without any thought when they are going to come out or where they are going to come out. Now, this puts many people in a situation whereby you have gone into the ocean, you accumulated a lot of fish, which is money and profits, but then you realize that you are closer to Australia than to South Africa. Then you say, I didn't plan to be in Australia. How do I get out of the markets? Then now you have to trade your profits to come out, because you had not chosen to be at the place where you found yourself. In other words, you were found in an instance of surprise that, oh, now that I'm here, what's next? Where do I come out? So you need to be sure of where you need to exit. What I do as a simple strategy is to say, whatever I invest must earn. And whatever it earns, it must also grow. So normally when I buy shares, I look for a share that I buy today in expectation that is going to rise, let's say maybe 50% in the next month or two. When I hit that target of 50%, I have a plan to say when my target is reached, I'm expecting the share price probably to pull back. let me sell 70% of what I bought. This way, I'm keeping the profits, and when the price starts going downwards, it will not be a severe drawdown on the profit that I've left remaining. When it comes to another buy level, I still have some bit of profit. Then I buy again, and the momentum carries me upwards. That way, I'm making money. That's what you need to be consistently harvesting from this ocean that you find yourself in. Another strategy that you can apply is to say, suppose you buy something at 10 Rand. After maybe 2 months, you find it has gone up maybe 3 times. So now it's at 30 Rand. Then you need to think that, okay, what I have put in as capital is 10 Rand. It has grown beyond that capital thrice. Then you look at taking out the full capital amount that you have invested. Now what you have remaining is purely profit. Now psychologically you are in a great place, because losing out on what you have as profit is not the same as losing your capital. Once you take that capital out, you already have a plan. You have identified where to go next. You have found another place where the risk and reward ratio is such that you are going to gain more than you are going to lose if you stayed in your position. So you take the capital, employ it in that other place where you identified prior to getting in. When you're there, you're expecting another double or another 70%. You again take out your capital, you leave the profit. That way you are now expanding your base. In other words, you can say I've got 20 shares in my portfolio that are purely profit because they were bought and you managed to take out the capital. Once you are in that position, you are in a strong place where you can make better decisions and better judgments. Even market crashes suddenly do not move you because you know what you are doing and you know that you have accumulated more than the capital that you have put in. This is the compounding effect that you will be applying as you engage in the markets. You don't want to be that person who buys Sasol at 50 Rand, it goes to 150, then it starts pulling backwards, it gets back to 70, then you're now saying, oh, I've lost so much profit, if only I had sold at that time. When you have a strategy you don't regret, you stick to it and you consistently apply it, and you are able to harvest from the markets consistently. Then the other thing which you need to consider as part of your strategy is economic cycle and business cycles. So as you can see, economies move in waves. These economic calamities that come here and there, they are built into the system that we call capitalism. Things go up, they overheat, they crash. It begins again, they overheat, they crash. So when things crash, you need to make sure that you are an active participant in the market. You have built a portfolio, you have got profits. When you see things crashing, you can trim some of your positions, keep some cash. Come the time for bargains, you apply that cash to buy the bargains when things reach a bottom or are close to the bottom. That way, when things pick up again, you quickly double or triple what you had put in, then you are able to harvest more consistently. Now, as part of your strategy, you need to study these cycles, such that when you are at the top, you want to be doing the smart thing. Usually at the top is where you see everyone is prospering. People are buying houses, people are buying cars, people are having babies, people are going on holiday and everything. Then suddenly after that, there is pandemonium, jobs are being shared, the economy is crashing, people are regretting, if only I didn't buy this car a year ago, now I've lost my job. Those things happen to ignorant people. It shouldn't happen to you once you choose to become an investor, because you are intentional. You engage the economy intentionally, watching where things are going and where they are likely to go, such that nothing surprises you or nothing moves you, because you know that your portfolio is a defense. The money that you have built is a defense. Even if you are told your job is done, You know that, okay, tomorrow I know my bills are going to be paid from the markets. That's how confident you should be when you continue to be consistent in applying your investment strategy. Then finally, your strategy is to incorporate the big picture. Most people are in it to buy a house, to have a nice car, to be able to enjoy themselves on holiday. But think about it, financial freedom is not a once-off thing. It's something that you need to inculcate into your family and siblings and cousins and everyone. It's no use for you to be financially free among people who are burdened, who are in poverty. Soon that weight of poverty is going to pull you down back into that black hole. So you need to be strategic about it, and you need to look at branching out. You have made triple or 10 times the profit, take some out, buy maybe 4 food trucks, bring in your cousins and say, I'm going to employ in this business of food trucks. You are now a worker, it's now a business, or you give them shares, however you want to do it. That way you are diversifying your portfolio. You are now aiming to become the next Jeff Bezos or Strive Masi or Aliko Dangote. And in doing that, you are also picking people who can succeed you. Because if you look at Rothschild and Oppenheimers, those people, in as much as people say they are Illuminati, I believe they are not. They are just smart people who have learned to pass on their wealth and the knowledge of wealth to the coming generations. Then we look at them succeeding and think there must be something that they are doing. No, they simply use their head like we all should use our heads. Africa is a place where there's plenty of problems, plenty of needs that need to be met. Pick some of those needs and meet them via your profits that you harvest from the markets. Now you do it in such a way that you're going to get a return. You're selling a service or a product. Then you continue to be growing. Then you have time to think and say, what if I invest in AI? Can I bring something that we can sell to Google for maybe 10 billion after putting in maybe 2 million rand? Those things are possible only if we are intentional and are able to think big about investments. Or maybe alternatively, come together as maybe 5,000 investors. We have made so many profits. Let's put maybe 1% of our profits into some new venture. You come together, you do it. Come the time of harvest, you are doing very well. Maybe it's a 10-bagger company. You are building and expanding the base in Africa. Currently, our biggest challenge is we don't have strategic people. Hence, we just eat everything that we get. We don't really think about tomorrow, what we are going to do when calamity comes. Hence, we are always found wanting. So we should try and overcome that. But it can only happen if we are intentional in what we do with what we have. So that is all about strategy. You can ask me anything about strategy. If you're struggling with strategy, we can sit and try and craft it and see how we can work around it. I'm always happy to assist people and to guide people even to find their way to say, okay, I do not know how to identify this, how to identify that. We need to be doing that. Also, try to learn some basic economics. This will greatly help you on the journey to financial freedom and accumulation of wealth. Until the next episode where we dig deep into the markets, happy investing, and I look forward to hearing your strategy and you prospering thereof. Have a great day.